The sooner you can start your small business financial planning for next year, the better. To get a jump on your to-do list for 2025, Next has compiled a list of tasks to help you and your business get the most out of the next calendar year. The 11 financial planning tasks for small business owners include: create attainable goals for the year, make a roadmap to scope out every goal, create a financial plan for the next fiscal year, set up or refresh cash flow projections, add 2025 tax dates and deadlines to your calendar, come up with a basic risk management strategy, review your marketing strategy, assess your financial performance, review your tax obligations, review your employee benefits, review your company culture, review your business continuity plan. Setting the foundation. Understanding your goals before embarking on a journey to achieve your goals, it's essential to start by setting a clear direction. This involves defining what you want to accomplish and why. Take some time to reflect on your goals and ask yourself, what are my long-term objectives? What are my short-term goals? What steps can I take to achieve these goals? ##, breaking down goals into smaller tasks *, breaking down goals into smaller tasks. Once you have a clear understanding of your goals, it's time to break them down into smaller, manageable tasks. Plan ahead for tax time to avoid stress and mistakes. A well-organized system helps you stay on track and avoid costly mistakes. Planning for tax time. As tax season approaches, it's essential to start planning ahead to ensure a smooth and stress-free experience. This involves several key steps that can help you navigate the complex world of taxes. Understanding your business structure. Before diving into tax planning, it's crucial to determine your business structure. This decision will impact your tax obligations and responsibilities. Here are some common business structures to consider. Sole proprietorship. As a sole proprietor, you report business income on your personal tax return, Form 1040. You're responsible for paying self-employment tax on your net earnings from self-employment. Limited liability company, LLC. An LLC provides liability protection and flexibility in taxation. You can choose to be taxed as a sole proprietorship, partnership, or corporation. Corporation. A corporation offers liability protection and can provide tax benefits. However, it's a more complex structure that requires more formalities. ##, researching tax dates and deadlines *, researching tax dates and deadlines to avoid last-minute stress. Research the tax dates and deadlines. Gather, analyze, grow, the three-step process to creating a comprehensive financial plan. Gathering essential data. To create a comprehensive financial plan, you need to gather essential data. This includes financial statements from the previous year, such as balance sheets and income statements, historical data on revenue and expenses, projections for the upcoming year, including projected income and expenses, information about your business's cash flow, including accounts receivable and payable, details about your business's assets, including property, equipment, and inventory. Gathering this data will provide a solid foundation for your financial plan. It will help you understand your business's financial performance and identify areas for improvement. Analyzing the data. Once you have gathered all the necessary data, it's time to analyze it. This involves reviewing your financial statements to identify trends and patterns, analyzing your revenue and expense data to identify areas for cost reduction and optimization, examining your cash flow data to identify areas for improvement, reviewing your asset data to identify opportunities for growth and expansion. By analyzing your data, you can gain a deeper understanding of your business's financial performance and identify areas for improvement. Identifying trends and opportunities. As you analyze your data, you'll likely identify trends and opportunities that can help your business grow and thrive. Here are some key points to consider when managing your cash flow. Understanding cash flow. Cash flow management is the process of monitoring and controlling the flow of money into and out of your business. It involves managing your accounts receivable, accounts payable, and cash reserves to ensure that you have sufficient funds to meet your daily operational needs and invest in your business's growth. Key components of cash flow management. Accounts receivable. This refers to the amount of money that customers owe you for goods or services sold on credit. Effective management of accounts receivable involves setting clear payment terms, sending reminders to customers, and following up on overdue payments. Accounts payable. This refers to the amount of money that you owe to suppliers or vendors for goods or services purchased on credit. Effective management of accounts payable involves paying bills on time, negotiating with suppliers, and taking advantage of discounts. Cash reserves. This refers to the amount of money that you have set aside in a savings account or other liquid asset. Effective management of cash reserves involves maintaining a sufficient level of liquidity to meet unexpected expenses or revenue shortfalls. ### forecasting cash flow *** forecasting cash flow. Forecasting cash flow involves predicting the inflows and outflows of cash over a specific period of time. This can be done using historical data, industry trends, and other relevant factors. By forecasting cash flow, you can identify potential cash shortages in advance and take steps to avoid financial difficulties. Techniques for forecasting cash flow. Historical analysis. This involves analyzing past cash flow data to identify trends and patterns. Understanding tax planning aids. Tax planning aids are tools and resources that help businesses make informed decisions about their tax obligations. Stay on top of tax filing deadlines to avoid penalties and ensure compliance with tax laws. April 18, 2025, deadline for filing Form 1099 MISC for non-employee compensation. Tax filing deadlines for business owners. As a business owner, it's essential to stay on top of tax filing deadlines to avoid penalties and ensure compliance with tax laws. The Internal Revenue Service, IRS, sets specific deadlines for various business entities, and it's crucial to understand these deadlines to avoid last-minute rushes. Understanding the tax filing deadlines. The IRS provides various tax filing deadlines for different business entities. Here are some key deadlines to keep in mind. 1099 forms, January 31, 2025. Some 1099 forms are due for partnerships, multi-member LLCs, and S corporations. C corporation returns, April 15, 2025. Taxes due for C corporation returns. Form 1099 MISC, April 18, 2025. Deadline for filing Form 1099 MISC for non-employee compensation. ### preparing for tax filing deadlines ***. Preparing for tax filing deadlines to ensure compliance with tax laws. Business owners should take the following steps. Keep accurate records. Maintain accurate and detailed records of income, expenses, and other financial transactions. Consult with a tax professional. Engage a tax professional to ensure compliance with tax laws and regulations. File tax returns on time. File tax returns by the specified deadlines to avoid penalties and interest. Mitigating financial losses through effective risk management strategies. Understanding the importance of risk management. Risk management is a critical component of any business or investment strategy. It involves identifying and assessing potential risks, and developing strategies to mitigate or manage them. Effective risk management can help you avoid financial losses, protect your assets, and ensure long-term success. Key components of a risk management plan. A risk management plan typically includes the following components. Risk identification. This involves identifying potential threats to your business or investment, such as market fluctuations, regulatory changes, or natural disasters. Risk assessment. This involves assessing the likelihood and impact of each identified risk and determining the best course of action to mitigate or manage it. Risk mitigation. This involves developing strategies to mitigate or manage identified risks, such as diversifying investments, hedging, or transferring risk to a third party. Review your business insurance coverage to ensure you have the right protection in place for the new year. Review your business insurance coverage as the year comes to a close. It's essential to review your business insurance coverage to ensure you have the right protection in place. This review should include checking your liability insurance to ensure it covers any new or increased risks, reviewing your property insurance to ensure it covers any new or increased assets, verifying your workers' compensation insurance to ensure it covers any new or increased Employees reviewing your business interruption insurance to ensure it covers any new or increased risks. Key considerations when reviewing your business insurance coverage. There are several key considerations to keep in mind. Changes in business operations. If your business has changed in any way, you may need to adjust your insurance coverage. For example, if you've started a new product line or service, you may need to add new coverage to protect against potential risks. Increased assets. If your business has increased its assets, you may need to adjust your property insurance coverage to ensure you have adequate protection. New employees. If you've hired new employees, you may need to adjust your workers' compensation insurance coverage to ensure you have adequate protection. Professional liability insurance covers errors and omissions in professional services. Cyber insurance protects against cyber attacks and data breaches. Types of small business insurance. General liability insurance. General liability insurance is a type of insurance that protects small businesses from financial losses due to accidents or injuries that occur on their premises or as a result of their products or services. Year-end review and planning. As the year comes to a close, it's essential to take a step back and assess your business's performance. This is the perfect time to review your inventory and vendor relationships, ensuring that you're making the most of your resources. By doing so, you'll be able to identify areas for improvement and make informed decisions for the upcoming year. Reviewing your inventory. Review your inventory levels and adjust as needed to avoid overstocking or understocking. Consider the expiration dates of perishable items and plan accordingly. Evaluate the condition of your inventory and consider disposing of any damaged or obsolete items. Reviewing your vendor relationships. Reviewing your vendor relationships. Evaluate the performance of your vendors and consider switching to more reliable suppliers. Review your contracts and negotiate better terms if possible. Consider implementing a vendor rating system to track performance. Reviewing your deliverables and costs. Reviewing your deliverables and costs. Review your deliverables and ensure that they align with your business goals. Evaluate your costs and identify areas where you can reduce expenses. Consider the costs of equipment maintenance, replacement, and disposal. Consider the costs of software and office supplies. Consider the costs of employee training and benefits. Consider the financial implications of increasing or decreasing staff. Financial planning for small business owners. A comprehensive guide understanding the importance of financial planning as a small business owner. Financial planning is crucial to ensure the long-term success and sustainability of your company. It involves making informed decisions about investments, expenses, and revenue streams to achieve your business goals. Effective financial planning can help you navigate the challenges of running a small business, including managing cash flow, reducing costs, and increasing profitability. Identifying areas for cost reduction. One of the key aspects of financial planning for small business owners is identifying areas where costs can be reduced without compromising the quality of services or products. This involves conducting a thorough review of your office equipment, manufacturing facility, commercial kitchen, or other production and workflow areas. Consider the following: equipment maintenance and replacement. Regular maintenance can help extend the life of your equipment, reducing the need for costly replacements. Software and office supplies. Review your software and office supply contracts to ensure you're getting the best deals. Employee training and benefits. Consider the costs of employee training and benefits, and explore ways to reduce these expenses without compromising employee satisfaction. Evaluating the financial implications of staffing decisions. Evaluating the financial implications of staffing decisions. Another critical aspect of financial planning for small business owners is evaluating the financial implications of staffing decisions. This involves considering the costs of increasing or decreasing staff, including equipment and software costs. New equipment and software can be expensive and may require significant upfront costs. Employee benefits and training. Increasing staff can lead to higher employee benefits and training costs. A financial planner can also provide guidance on investments, tax planning, and cash flow management. The importance of a financial planner for small business owners. As a small business owner, you wear many hats. You're the CEO, the accountant, the marketing expert, and the customer service representative all rolled into one. However, managing the financial aspects of your business can be a daunting task, especially when you're trying to focus on growth and innovation. Why you need a financial planner? A financial planner can help you navigate the complex world of finance and make informed decisions about your business. Here are just a few reasons why you need a financial planner. Expertise. A financial planner has the knowledge and experience to help you make informed decisions about your business. They can provide guidance on investments, tax planning, and cash flow management. Objectivity. A financial planner can provide an objective perspective on your business, helping you to identify areas for improvement and develop strategies to address them. Time saving. A financial planner can save you time and effort by handling tasks such as budgeting, forecasting, and financial reporting. Risk management. A financial planner can help you identify potential risks to your business and develop strategies to mitigate them. What a financial planner can do for you. What a financial planner can do for you. A financial planner can help you create a tailored plan that aligns with your business goals and addresses your specific needs. The role of a financial professional in entrepreneurial success. As an entrepreneur, navigating the complex world of personal finances can be overwhelming. With multiple responsibilities, such as managing a business, caring for family, and pursuing personal goals, it's easy to let financial planning fall by the wayside. This is where a financial professional comes in, to provide expert guidance and support in achieving entrepreneurial success. Key areas of expertise. A financial professional can assist entrepreneurs with a range of personal finance tasks, including retirement planning, creating a comprehensive plan to ensure a secure financial future, including setting up a retirement account, investing in a diversified portfolio, and developing a strategy for maximizing retirement income.